Hi, and welcome back to the Food Fund, where we analyze investing in food, beverage, and restaurant stocks. In this video, we will be evaluating the portfolio performance for July 2025. I added a new holding to the portfolio and sold a position for the first time, so be sure to watch through the end of the video to find out what I did. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. Now, let's get started. Cue the logo. Let's start off with the market's performance. For the month of July, the S&P 500 gained about 2.2% in terms of share price appreciation, but about 2.4% total return. The market raced up and hit new all-time highs. When we look at the companies that make up the S&P 500, we can see that there were big gains again in tech. Companies like Microsoft, Nvidia, Amazon, Alphabet, and Meta all gained a lot. Over in our corner of the market, consumer packaged food, farm products, alcoholic beverage, confectionery, non-alcoholic beverage, and restaurant companies all fell. It was a tough month for food, beverage, and restaurant companies as tariff talks intensified. July also had some notable earnings reports. Starbucks, the popular coffee house, reported mixed results. Earnings per share was 50 cents, coming in under estimates of 65 cents, while revenue beat, coming in at $9.5 billion versus the $9.3 billion estimated. Unfortunately, same-store sales declined 2% and may spell trouble ahead. Wingstop, the popular chicken restaurant, logged a better earnings report despite facing similar underlying issues. Earnings per share came in at $1, beating estimates of 88 cents, and revenue was $174.3 million, beating estimates of $173.4 million. The company did have a same-store sales decline of 1.9%. CEO Michael Skipworth had this to say in an interview on CNBC.
We did post a decline in same-store sales of 1.9%, but actually that's a number we're pretty proud of. When you look at our business over the last 3 years and you stack our growth, we've grown over 40%, which I think just showcases the staying power of the strategies that we're executing.
Despite the same-store sales decline, consumers are clearly finding value as new locations continue to open with high-level efficiency. Following the earnings report, the share price rocketed up more than 25%. Okay, let's move on to the portfolio performance. I deposited $100 into the account on July 1st, 2025, and at the end of the month, the portfolio balance was $1,483.13. This means the portfolio lost $9.53 for the month, representing a 0.6% loss for July. Losing money never feels good, but it is important to be transparent. And I think we are building a better portfolio for the future, but more on that later. Given the S&P 500's 2.4% return, we lost 3 percentage points of alpha by following our strategy and not being invested in the S&P 500 this month. Ouch! Our streak of outperforming the S&P 500 has ended at 5 months in a row. All streaks end so that a new one can begin. Looking at our performance chart versus the S&P 500, we see that despite the down month, we are still outperforming the S&P 500 when taking into account total return on a month-by-month basis. Since inception 13 months ago, the portfolio has had a 12.5% cumulative return on a money-weighted basis, while the cumulative return on a time-weighted basis was 14.1%. I've also added the CAGR, or compound annual growth rate, now that the portfolio has passed 1 year. I find the CAGR to be a more helpful metric to track asset performance from this point on. It allows us to estimate annual returns quickly. Given the S&P 515.7% cumulative return, the CAGR was 14.5%. This means that the portfolio trails the S&P 500 by a 3 percentage point CAGR since inception. From now on, the goal will be to close that 3-point gap and never fall below again. Okay, let's take a look at some key holdings in the portfolio and explore my new holding and what I sold. Pepsi has taken the lead as my number one holding. My Pepsi position has 2.21 shares at a cost basis of $143.29. This position is down 3.7%. Pepsi makes up 20.5% of the portfolio, slightly down from last month. At an over 20% position, Pepsi continues to be a cornerstone of my portfolio. I anticipate that its weight in my portfolio will decline over time, but it has the largest market share, diversified brand portfolio, and a long runway ahead of it. Celsius is my number 2 holding, having ceded the number 1 position to Pepsi. With 6.59 shares at a cost basis of $32.08, this position is up 41.3%. Celsius makes up 20.1% of the portfolio. Again, I'm happy with this portfolio weight and would only add if the share price fell significantly. Skipping down to Chipotle, the Mexican restaurant is my number 4, holding with 3.83 shares at a cost basis of $49.86. This position is down 14%. Chipotle makes up 11.1% of the portfolio. I took advantage of the share price fall following the earnings report and will continue to average down. Though same-store sales are falling, market share growth is maintained as same-store sales are falling throughout the restaurant industry. Chipotle will be fine in the long term. I'm not worried, but should I be? Now let's talk about my new position, Chagee. For those that don't know, Chagee is a new tea house restaurant brand from China. Chagee is my number 5 holding with 7.19 shares at a cost basis of $23.64. This position is down 6.5%. Chagee makes up 10.7% of the portfolio, which is a bit more than I intended this early in holding the company. However, I think Chagee has a great chance to be a strong company in the coming years. They are growing efficiently, have a strong balance sheet, and are already profitable. Check out my recent Chagee stock analysis video for more, and let me know what you think of the company. What some of you might have noticed by now is that I sold my Hershey position. Hershey was a company that I started to feel dissatisfied with a while ago. Though cocoa prices have fallen from their peak as I predicted, the fundamental performance continued to be lackluster. It was slow growing, inefficient, and was not the stabilizing holding I had hoped it would be. I sold the position for a moderate gain and allocated those funds into my new position. Last, let's look at the cash position. I deployed way more cash in July than last month and have a cash position of just $13.11 remaining. This makes up less than 1% of the portfolio, down from the 3% cash position I held last month. The last day of the month proved to be too good of a buying opportunity to pass up. As far as the weighted average metrics for the portfolio, nearly every metric is now better this month. Gross margin rose from 43% to 44%. Revenue per share CAGR rose from 28% to 60%. Free cash flow per share CAGR rose from 55% to 110%. Return on invested capital rose from 18% to 33%. Cash conversion cycle is down to 0 from 5, and yield on cost is now 2.8% from 2.4%. Only net debt to EBITDA remained unchanged. Looking forward, there are still many challenges plaguing the portfolio. Tariffs haven't really been implemented, so we don't yet know how badly it will hit consumers. Still, all of the restaurant earnings reported recently has falling same-store sales. That is never a good sign. My hedge against that is Chagee. With only one store in the United States, Chagee's fundamentals are free from the tariff talk mess. And with the US dollar rapidly falling, Chagee gives me a growing company in one of the fastest growing regions of the world with strengthening currencies. That's the plan anyway. We'll see how it plays out. Many thanks for watching. What do you think about the portfolio? Share your thoughts below. It is always great to hear from you. Check out some more videos right now, and don't forget to put your money where your mouth is.